Hi, and welcome to today's class, where we will cover substantive audit programs, a continuation of last session's Chapter 10 Introduction. Substantive procedures as an audit procedure are designed to detect material misstatements at the assertion level. They comprised of tests of details, of class, of transactions, account balances and disclosures, and substantive analytic procedures. We'll look at a transaction and subsystem approach to substantive testing. So let's look at the design of substantive testing and take the subsystem of sales. What we can do is we can select a sample of individual entries in the journal and vouch to source documents. We can select a sample of shipping documents, vouch these to sales invoices, then trace to journal and posting to subsidiary ledger. We can perform year-end cutoff tests, review the accuracy of sales invoices and sales journal, review the sales journal for unusual items, or perform analytical procedures. As previously mentioned, the objectives and assertions that need to be tested are existence, completeness, valuation, and accuracy. The questions we must ask are: were sales that are reported in profit and loss actually made? Did they actually occur? Does the sales figure in the draft trial balance show the complete total for sales? Is this consistent with the completeness assertion? Are they valued correctly? Were they all accurately recorded? It's important to do a review around cut-off dates to ensure that all sales were recorded in the correct accounting period. Have a look at page 243 for examples on adjusting entries that may need to be made to rectify any issues. This needs to be completed for all subsystems. Now, if we consider the risk of misstatement in the revenue cycle, while sales transactions are routine for most organisations and do not represent an abnormally high risk, for other organisations, revenue recognition may be complicated. Difficult audit issues arise, such as recognising revenue in the wrong accounting period. So when should the client actually recognise the revenue? The auditor must understand the client's operations and the related accounting standards. An example of this is in the construction industry, where the auditor must look at the point of sales revenue recognition versus the percentage of completion. 2. Impact of any unusual sales terms and whether title has actually passed. Were there related party transactions? Were the goods recorded as sales and have they been shipped? If sales made with recourse or that have significant returns, so example, irrevocable right to return goods, the presence of all of these issues increase inherent risk and the probability of material misstatement. AASB 118 advises us on revenue recognition. Revenue shouldn't be recognised until it's actually earned. The following criteria should be met in applying this concept. The risks and rewards of ownership are transfer, so there is evidence of an arrangement. There is no longer management or control over the goods, so delivery has occurred. The revenue amount can be measured reliably, that is, the seller's price to the buyer is fixed or determinable, and is probable the economic benefits will be collected. Collectability is reasonably assured. Let's have another look at another subsystem now, in purchases. We're looking at the design of these tests. What can we do? We can select a sample of transactions from the payments journal and vouch them to supporting docs. We can select a sample of receiving reports and trace them to entries in the vouchers register and payments journal. We can perform year-end purchases and cut-off tests. Perform recalculations on suppliers' invoices to verify accuracy. review the purchaser's journal for unusual items, trace and vouch purchases, or analytical review. Let's now look at the other subsystem in accounts receivable. What can we do? We can verify the accuracy of the accounts receivable trial balance figures, reconcile them to the control account and subsidiary ledgers. We can apply an analytical review. We can send out letters to debtors confirming balances, vouch recorded receivables, perform sales cutoff, review adequacy of the provisions, review an aged analysis of debtors. So these are further tests specifically in relation to accounts receivable. So let's look further into the confirming of the receivables with customers. Confirmations provide reliable external evidence about the existence, and they are required by auditing standards. It's a confirmation of the existence of recorded accounts receivable and the completeness of cash collections, sales discounts, and returns. And they are required, as I said, unless one of the following applies. The receivables are not material, or the use of these confirmations would be ineffective, or the combined inherent and control risk is low. So a really important point to note is positive confirmations. What is it? This is where customers are sent a confirmation letter and they are asked to agree the amount on the confirmation with their accounting records. They must then respond directly to the auditor whether they agree with the amount or not. So in this instance, it does require an actual response. And if the customer doesn't respond, the auditor may use an alternative procedure. Alternatively, negative confirmations are where customers are asked to respond only if they disagree with the balance. This method is less expensive and it may be used when all of the following are present. You're confirming a large number of small customer balances, or the inherent and control risk is assessed as low, or the auditor believes customers will give proper attention to the confirmations. Why then are positive confirmations considered more reliable? Well, there's two very important points. The assumption that a negative confirmation it is not returned represents a correct receivable balance is not always valid. There's a number of reasons why it might not be returned. It might have been lost, the difference was in customer's favour, or the customer did not understand their request and threw it away. And also, with positive confirmation, follow-up procedures are performed to provide evidence that the receivable exists and is accurate. If they don't respond to the first request, they may send a second, third, maybe fourth request. If the customer still doesn't respond, they'll use an alternative procedure. They'll examine the cash receipts journal for cash collected after year end. They'll examine documents supporting the receivable, such as the purchase orders, invoice, shipping documents. And it's important from the perspective of cut-off. Has these transactions occurred prior to year end? It's not as reliable as the externally prepared documents though. Differences in the amounts are called exemptions, and the reason for the exceptions are timing differences or disputed items, errors or misstatement. The auditor must determine the reason for the exception. We now look at the next subsystem in accounts payable. These are some of the tests that can be performed. We verify the accuracy of the accounts payable trial balance figures, apply analytical review, voucher recorded payables, confirm trade and sundry creditors, perform purchase cutoff test, cash payments cutoff test, search for unrecorded creditors. Another subsystem is inventory. We verify the accuracy of schedules and perpetual records. Observe the client's stock take, vouch the recorded purchases, review evidence from sales, inquire of management, test accuracy of calculations, review slow moving stock, review lower of cost and net realizable value. And we also have cash receipts and payments. What tests do we do around this area? We verify the accuracy of cash balances, apply analytical review, count the cash on hand, perform cash cutoff tests, confirm bank deposits, loan balances, trace bank transfers, vouch and trace transactions, review interbank transactions, complete account sheet when checking petty cash, cash flows and cash on hand. Non-current assets. Same again. In this instance, will inspect the property ourselves. We'll physically inspect it. We'll examine the title docs. We'll vouch the additions. We'll vouch the balances. We'll analyse the repairs expense to make sure there is no capital expenditure items classified as an expense. We'll review the accumulated depreciation, inquire with the valuation, and review fixed asset register. Payroll. What tests would we do around payroll? We'd review the records, review the payroll tax and deductions, review the payroll register, review the suspense account, recalculate the liability and provisions. Investments. We'll verify the accuracy of balances. We'll vouch entries into investment accounts. We'll recalculate interest earned. We'll reconcile the investment register. We'll apply account analytical review. Long-term liabilities. We'll verify the accuracy of balances. Analytical work, review authorization and contracts. We'll recalculate. So what we've done is, and finally, shareholders' funds. We'll verify the accuracy of balances, analytical work, inspect the share register, vouch entries to share capital, retain profits and reserves. So as you can see, that was a detailed approach to what sort of substantive tests we would give for each of the following or previous subsystems. And an alternative is a template approach, where a template approach looks at analytical work and finding relationships between the figures. So what you do is summarise the balance sheet into subtotals and assess the going concern with a number of ratios. So going concern ratios could include either the following. We have covered these in a previous session, and these will be used to determine if there is a going concern problem. We'll then assess the balance sheet structure and use the draft balance sheet and profit and loss provided by the client and check items such as depreciation, doubtful debts, provisions and amortization. Thank you for your time.